Hey, everybody, this is the Build Business Better podcast presented by Enterprise Sage. I'll be your host today. My name is Darin Kaiser. Craig is out today. I think he's probably riding a motorcycle around somewhere. So if you're in the Arizona area around Phoenix, Scottsdale, you see a very happy guy on a Goldwing out there serving business owners. Give him a wave. He might not be on his motorcycle. He's probably actually doing some work today. But you guys have a very special guest today. We have the Vice President for Caltius Structured Capital. Name is Kate McDonald. We had the pleasure of actually seeing her speak at ACG down in Phoenix. Great presentation, inspired us to reach out to Kate, connect with her on a number of different levels. And then I had the pleasure of actually spending some time getting to know Kate a little bit better at a local mixer. And it was awesome. Did a great event. A lot of good professionals. If you're in the Denver metro area and you're listening into this conversation, I highly recommend reaching out to Kate and her team at Caltius and getting connected. A lot of great professionals, a lot of young professionals, and a lot of seasoned veterans. Great conversation over some golf and some delicious food down at the Castle Pines Country Club. So with that, Kate, welcome to the show. And
Thank
I would
you.
love for you to give me just a little high-level overview of who you are, what you do, and if you could, explain to me how you would describe what you do at Caltius over coffee.
Yes, absolutely. Well, really appreciate you having me here today and looking forward to the conversation and giving people more insight into who I am, but more importantly, who Caltius is. So I am Kate McDonald. I am a vice president on the investment team at Caltius Structured Capital. I have been there coming up on 7 years now, so have had a great run with the team. We are a fund. We're based out of Los Angeles, but I sit here in Denver. And what we do is we provide capital to business owners who want or need capital but aren't yet ready to give up operational control. So we focus on the lower middle market and companies that are cash flow positive and are looking to do a number of things. We can help fund shareholder dividends, we can help fund succession planning, we can help fund acquisition capital, all situations where the business is looking for capital, but that owner does not want to cede control to an outside institutional investor. So I'm sure we will jump into examples of that as we continue the conversation, but high level over coffee, that is what we at Caltius do.
I love it. That's a great definition. What made you want to work for Caltius specifically?
Yeah, absolutely. Great question. I love where Caltius plays in the capital stack. I think we partner with business owners who have spent years and years and decades of their life building these businesses. And in many cases, it's their babies. They have put sweat, blood, and tears into these businesses. And so we can come in and partner with these business owners and allow them to grow the business or take some chips off the table without giving up operational control of those businesses. So I really like that we provide an option to give the business owners capital and potentially realize on some of their hard work without them feeling as though somebody's coming over, taking over control, potentially changing the culture, all of that. So I love that we play in that role at Caltius. We ourselves are a founder-owned business. The three founders started Caltius in 1997. They are still very involved, and we understand how important the culture is to businesses, especially when founders have started and grown those businesses. I one thing I love about Caltius and just a fun stat is north of 50 executives have invested alongside us in our subsequent funds. So we allow companies that we've invested in to then turn around and invest their personal capital alongside of us in the next funds. And we've had so many executives do that, which I think just speaks to how Caltius is as a partner and where we
Awesome.
play is we really help these business owners grow their company without taking over the business.
Okay. I heard you mention this a couple times. Take over or take control, or I can assume that the person listening in as a business owner they may hear the term private capital and they go, I'm reluctant to do that because somebody's going to come in and take shares, or they're going to take equity, or they're going to, I'm going to give up something I don't want. So help me understand what how does structured capital work differently? Like, what are like the main couple nuggets that like a business are going to take from today?
Yeah, absolutely. Great question. So we sit in between senior debt and common equity. So senior debt you can get from a bank. They often do not provide as much capital as we would be comfortable providing. They sometimes have personal guarantees, which we do not have. On the other side of the capital stack, common equity often comes in and purchases the vast majority or a majority of the business. And in doing so, they then take over operational control. And so they are then able to make operational decisions, fire, hire, all of that good stuff because they now own the business. We do not own the business. So we come in with a debt and sometimes minority equity solution that allows the business owner to continue in the vast majority seat operating the business. And we sit as an advisor and as a partner, not as a private equity fund that's going to take over control and buy the business.
Okay, I like that. And so it gives business owners options. It gives
Correct.
them
Yeah.
variability there. So go back and explain a little more in detail the fit between the traditional bank loan and selling equity.
Yeah, absolutely. So traditional bank loan, they can sometimes take a personal guarantee. It's often with large institutional banks, and so is not as flexible as a Caltius debt provider would be. So we are often more comfortable providing more capital than a traditional bank loan would be able to provide. We have no personal guarantees. We do not base the loan off of assets. We base it off of cash flow. On the flip side, we are usually slightly more expensive than bank debt, but we are non-amortizing. And so instead of having a bank term loan where you are paying amortization as well as interest, we are interest only with the balance due upon maturity.
Mm.
And then we often do invest minority equity alongside our debt as well. But again, are much less dilutive than a true minority equity fund, and are less dilutive than a buyout fund that is coming to purchase the assets of the company.
Okay. So like practical application, like what does it look like for a business to grow without conceding some of that control?
Yeah, great question. So, um, in practice, and it might just be best for me to give an example. So,
Awesome.
in the last few years, had a business owner approach us. That business owner was looking to buy the competitor down the street, needed 15 million of capital to do that. We can come in and provide, in this example, 10 million of that is debt, and then 5 million of that is minority equity. So the debt is priced with a interest rate, call it between 11 to 13%, just depending on the risk profile of that debt investment. No amortization, so all principal is due upon maturity. And then the equity will be structured as a minority equity. Depends on the size of the business where that comes in. It can come from 3% up to 20%, again, just depending on the size of the business and how much capital they're looking for. And then as a minority equity, we just ride alongside the majority owner, the business owner, and allow that business owner to continue to make all the major decisions. And the ultimate exit, if he or she wants to sell, is their decision. We do not dictate that. We do not dictate strategy. We do not dictate hiring. We do not dictate firing. So all those major decisions still sit with that business owner.
Okay. All right. And so when should I'm curious, when should the business owner or the founder start thinking about bringing in private capital instead of relying on bank financing?
Yeah, that's a great question. And I would say it's situation specific. For that example, where it was an acquisition, reach out once you have an acquisition in mind because the size of the acquisition is going to dictate how much capital you need. And then it will dictate if a senior bank's able to do that or if someone like us is a better fit. Another example of capital that we often provide is succession planning, where we help younger generations buy out mom and dad, and it doesn't even have to be family related. It can be the younger management team buying out the inactive founders. And we can provide great solutions in those scenarios because by utilizing debt and minority equity, we can get the older generation liquidity, but get the majority of equity into the younger generation's hands. And so it's a win-win for all. It keeps the equity within the business, but gets the older generation the liquidity to go out and fund their fun years of retirement. In those situations, I would say the earlier you can start the conversations, the better. And so we can come in and start to understand the capital stack, start to understand the younger management team and who's stepping into those executive positions and help with the transitions. I also think, Darin, having someone like you go in to help businesses earlier rather than later can also be very beneficial through those transition periods. And as companies are trying to ensure that their financials are clean and are able to be diligenceable. So as you start to think that that could be an option, bringing in an advisor and then starting the conversation early is never a bad idea.
Yeah, I'm thinking of a couple cases in particular where, owner is maybe 3, 5 years out. They've
Mhm.
got either, somebody next in line internal to the company, or they might have a staff. They might want to do an ESOP potentially, or they might have, one case in particular, um, director of operations, great young, motivated staff member who would probably succeed in the future, but doesn't quite have the capital to take
Mhm.
over and allow the senior owner to exit cleanly. And so this is where Caltius could come in and provide support to that transitionary process.
Exactly. Yes,
Awesome.
exactly. And we've seen situations where younger generation is running the business, but mom and dad are still taking out cash flow, and it makes it hard for the younger generation to efficiently run the business because they're worried about making sure that mom and dad have that cash flow and might not make the same decisions that they otherwise would in terms of investing that cash flow back into the business and utilizing it for growth. And so what we can do is come in the example I'm thinking of, give $20 million, which was then used to buy out mom and dad. The younger generation no longer has to worry about making sure that the cash flow can fund their life. Mom and dad are
Right.
fine, taken care of. And so then it just opens up the opportunities for that younger generation to run the business as they should be in their 30s and 40s, but they weren't because they were more conservative because they were still taking care of mom and dad with the cash flows.
Would this also, and I think you alluded to this with the word acquisition. So if I'm maybe looking to acquire a business, could I come to somebody like Caltis and say, "Hey, I need to do some cap raise because I want to buy XYZ businesses, maybe roll them up at some point." So that would that be a case where maybe I'm not the owner, but I'm looking to buy it externally? Would I want to come in and use that as a way to, make sure that I have the capital so I don't get beat out by another buyer?
Right. We don't do that as often. Our thesis is backing the management team that is currently at the business. And so we want to ensure that the management team has years of operating that business efficiently and we understand how they're going to operate that business. So we focus more on backing existing platforms rather than helping with the initial acquisition. Not to say we never do that, we will ever so often, but we're a better fit when the existing ownership is looking for capital for their business.
Okay, that makes sense. So, what are some of the common misconceptions that a business owner might have about alternative financing?
Great question. I think one is that we only come in when businesses are not performing correctly.
Hmm.
And that's not true at all. The vast majority of our investments are in very stable, very good businesses. We're just a better fit in those businesses than equity solutions because equity solutions are more expensive than debt solutions. So we're not coming into restructure a business or in poor performing businesses. That's not what all alternative financing does. So I think that's a misconception. I think there's also a misconception that alternative financing is incredibly expensive, and that's not correct either. We're more flexible than senior banks. We're less expensive than common equity. If you believe in the future of your business, we're significantly less expensive than common equity. So we are not, some loan sharks out there that are extremely expensive capital. And then I think the third misconception is that our goal is to ultimately own your business. And that could not be further from the truth. We do not run businesses. We're not operators. The last thing we want to do is own your business. We want to
Yeah.
back management teams that
Yeah.
run good businesses, and we can be there to partner and help, but do not want to do a loan to own or any type of that structure.
Okay. So I'm going to repeat back to you what I've heard. So number one, it's not a struggling business. This is a business that is probably doing fairly well, but looking for capital to either expand into some other alternative market or continue to grow what they've already established. They're just looking for a different capital solution. Um, Competitive pricing with banking, maybe even less in some cases.
I would
And
say that that's not, we're slightly more expensive than banking, but more flexible.
but more flexible. Okay,
Yeah.
so is it wrong to think, okay, if I need $1 million, what's that going to cost me if I go to Caltius? Is that the wrong way to think about it?
I would I would say, a $10 million loan from a bank is bank pricing right now. SOFR plus 300 is what we're often seeing. Caltius is a fixed rate, and so we're not floating, and we do not change our rate based on SOFR. And we would be, depending on the leverage and depending on the business, somewhere on the debt pricing between 11 to 13%.
Okay, so it might be a little more predictable,
Correct. Yeah.
part two. And then lastly, the goal, and there's no desire for Caltius to acquire businesses, get into the business ownership operations side of things, but there is an element of support that you guys provide to management teams.
Absolutely. Yes, that is all correct.
Okay, very cool. I like that. So, what are the kinds of business challenges that are a best fit for Caltius? Like, give me some examples of like, here are some ways in which we've really helped to invigorate a business or get them the fuel they need to like supercharge the engine.
Yeah, absolutely. I can give you some great examples of transaction structures and some problems that entrepreneurs have faced and how we've come in and helped. So, a great one is a number of years ago, we met an entrepreneur who was going through some transitions on the personal side. He was going through a divorce and needed to settle his divorce, and all of his assets were in his business. And he very much believed in the future of his business and did not want to sell, but also needed to settle this divorce. And so we went in, we provided him, call it 20, $30 million of capital for him to then take out of the business as a shareholder dividend and
Gotcha.
use to go settle his divorce. He continued owning the vast majority of his business and continued to grow it. And a few years later, sold it for a number that he was able to get at that time because it was a bigger business and a better business, but that he would not have been able to get when we went in and did the initial dividend. So, that's obviously a one-off situation where someone's going through something in their personal life, that it doesn't have to be a divorce. We've gone in because an entrepreneur wants to build a house in Cabo or send his or her kids to college, or just diversify his or her net worth and take some chips off the table. So,
Hmm.
by providing a shareholder dividend, we can allow that business owner to take the first bite of the apple, continue owning the vast majority, and then hold on and ultimately take a second, potentially larger bite out of the apple. So that's one example of where we can come in and provide a solution. The another example is what I've touched on somewhat, just succession planning and helping to buy out inactive founders. One deal that we did a number of years ago involved three brothers who had inherited their parents' business, and one of the brothers was very active, was the CEO, was growing the business, and the other two brothers had other passions and other lines of work and weren't involved in it. And so we came in and helped the CEO brother buy out the other two brothers. So consolidated ownership to the acting brother. The other brothers were happy because they got to go do whatever they want to do with that capital. And yeah, so we can provide solutions in that sense. And then again, in the acquisition financing world, we can come in and help a business buy the competitor down the street, and do a somewhat kind of the PE roll up strategy, but on a founder level. So we've talked to a number of entrepreneurs, founders who are watching what these private equity funds are doing, where they buy, a business maybe doing 5 million of EBITDA and then go buy five businesses doing 1 million of EBITDA for a lot less than they can then sell the $10 million business for. So they get EBITDA arbitrage on day one. And so a lot of founders are watching private equity funds do that and say, I could do that as well. We can come in and provide them the capital to do that acquisition strategy and grow the business through that again, and continue owning the majority of their business so they get the ultimate upside for doing that.
Okay, so for the listener out there, there have been a number of scenarios, I would say typical scenarios where a company starts to realize they need growth capital that Caltius can provide. There's a succession planning. There's I'm going to maybe acquire other businesses in my, you know, let's say stable. And what are some other like typical scenarios where the company starts to realize they go, oh, we this is the bottleneck. This is what we need, and Caltius can provide.
Would say the other scenario that we haven't talked on is just growth capital. And in that scenario, it has to be a unique situation for Caltius to come in. And it makes sense for Caltius to be the partner, because we do only invest in businesses that are generating cash. And so normally those businesses are more mature and don't need growth capital. But where we have been helpful is in some businesses where the core business is generating cash, a very stable, good business, and the management team wants to take a bet on a software
Okay.
or an adjacent type of business. We can come in and lend money to the core stable business that can then be used to fund the growth of this software or this growth entity, and allow them to use the capital to do that instead of using the cash flow of the stable business.
Right. Okay, and that makes sense. And I like the term core and adjacent, because I don't have to handcuff my core business to then invest in something that's adjacent to it that could actually grow the core or just not put all of our eggs in one basket.
Correct. Yeah,
Okay.
exactly.
Awesome.
Exactly. So we usually ring fence the losses or the growth of the adjacent business and put that in a separate entity. And then that entity can swing for the fences and have more
Yeah,
of an equity risk attached to it while maintaining the cash flow and the stability of the core business.
very cool. We've talked a lot about capital today. We've talked a lot about money. Okay. So beyond writing a check, just stroking the pen, what value does Caltius bring to management teams?
Yeah, great question. I mean, not me personally, this predates me, but the team has been there. The majority of the team have been there since the early 2000s.
Okay.
Have been doing this for 30 years, have invested in over 90 businesses, have seen a lot and have been through a lot. And so we are always here to be a sounding board, to help management with the big decisions. Again, we stay out of the small decisions unless you call us. We're happy to be involved in the small decisions as well.
Okay.
But just here to be a sounding board, and then also here to introduce people to our network. So we know a lot of various advisors, yourself included, that can help businesses when needed, know a lot of investment bankers, and can make introductions. And then we are most helpful on the finance side. And so if a business is looking to make an acquisition, we can run the numbers, we can help with the diligence, we can structure it, we can walk the business through that since we have done it so many times. And then also just help the business get more sophisticated on the financial reporting and the KPIs. And so if the business owner decides they do want to do that ultimate exit to private equity 2, 3, 4, 5 years down the road, we've helped sophisticate the finance function and which allows that ultimate exit to run more smoothly.
Okay, awesome. So you mentioned over the last close to 3 decades that Caltius has been integral in 90 different businesses. Obviously, not every company is ready for an investment. And so help me understand what is the mindset for Caltius when they're evaluating whether a company is ready for or not yet ready for an investment?
Yeah, great question. So we see probably 500 opportunities a year and invest in four businesses. So we're pretty selective in the businesses that that we invest in. And so I can just kind of run down the list of what we look for. So cash flow, we want to make sure that the business can adequately and comfortably service the debt, both in years when things are good and if there's a slight downturn. So we want to understand cash flow over various periods and various cyclical cycles. Any concentration. So if a business has two customers, that makes it harder for us to invest in it. Obviously, if one of those customers walks away, it's going to be very significant to the operations of the business. So we want to understand any concentration both on the customer side and the supplier side. We just diversification across, various products, various end markets, is something that we also look at. But I would say the big one for us is cash flow and just understanding cash flow and ensuring that the business has adequate cash flow to service the debt, is the kind of topic we look at. And then in terms of people, I mean, we want to understand the management team, and we are backing the management team. And so there's always, various meetings and various dinners where we want to make sure we trust the management team and we believe that the management team will act with integrity, and that they believe in the business and believe in the future of the business. So, there's the quantitative hard numbers, but a lot of it is also just the meeting the management team and ensuring that we get a good feeling of who these people are because that's who we're going to be partnering with.
Yeah, absolutely. I mean, there's some hard numbers that we need to work with, but there's also a lot of soft skill type things that might not be, it's a little I don't know, a little gooier than this
Absolutely.
black and white. And so that's good to know. And for those businesses that are out there that are struggling with maybe management teams or capital, you can't have a good business without good people, and you can't have a good business without flow of cash coming through in and out. Those are areas where, I would say an enterprise sage solution, some sage guidance, no pun intended, or pun intended, however you want to take that. That's where I think we really shine, and where we bring in professionals like Caltius that can really help with that when the timing is right. And that's a critical component is timing. And so for those of you who are listening in on this, if you're a business that is struggling with bankability or being considered from alternative capital solutions, it might be worth a conversation with us first, and we can help get you to a place where someone like Kate can go, yeah, we're a good fit for you, or maybe not quite yet. We've talked a lot about business owners wanting to buy competitors or maybe prepare for an exit. Help our listeners understand, how can structured capital really help with those transitions?
Yeah, absolutely. And just to clarify, help with the acquisition or help with the ultimate exit?
I would say let's start with the acquisition,
Okay.
then we can lead into the exit of the company. Because I think at some point in time, everything exits.
Yeah.
We don't get out of this life alive. Not to be morbid, but that's true. But what I would like to say is, let's start with, I liked that core and adjacent. It might be core and I'm adding to the core, but help us understand that.
Yeah, absolutely. I'm happy to just walk through kind of a hypothetical example of where we come in and then how that can be beneficial for the business and the ultimate exit. In this example, say a business is doing 5 million of EBITDA and wants to make two acquisitions of competitors that are each doing 2 million of EBITDA. We can come in and provide debt to allow that business owner to make those two acquisitions and acquire 100% of those two businesses. And now on day two, instead of running a $5 million EBITDA business, you're running a $9 million EBITDA business. And likely with those acquisitions, you've also diversified your customer base and your end market and potentially your products and just made a more attractive business for an ultimate exit. And by rolling up smaller businesses, you as a business owner often also get EBITDA arbitrage. So in this example, maybe that business owner was able to buy those businesses doing 2 million of EBITDA for
Mm,
5 times, but a business doing 9 million of EBITDA might be worth 10 times. And so immediately after that acquisition, the combined business is worth much more because it's larger, it's more diversified. And so by building a larger business, you can then turn around and 2 years down the road, sell it to private equity for a much larger number than you potentially might have been able to as a $5 million business. And by using debt capital to help you with those acquisitions, the business owner maintains the vast majority of the equity and thus gets the large upside of successfully running that plan and then turning around and selling it to private equity.
okay. Yeah, because seller risk kind of diminishes to some extent when there's a larger, more diverse business offering, so that can be more attractive and garner a larger dollar amount. I can understand that. That's great. Um, we've talked quite a bit about exits and acquisitions. For the owner, the business owner or founder that isn't looking to acquire, they're not looking to exit. That's not really on the horizon. They're wanting some more liquidity. They don't want to sell outright. Okay, what options exist for them?
I think our shareholder dividend option is a great option for them, which allows that business owner to take chips off the table, take that first bite of the apple, still run their business, still own majority of their business, and then they can decide if 2, 5, 10 years down the road they want to sell their business and get the large second bite of the apple at that time. But we see that often, and it's usually younger entrepreneurs, albeit not always, and maybe in their 40s who aren't yet ready to retire, but also aren't sleeping as well as they otherwise could be at night because they recognize all their net worth is tied up in their business. And so by taking a shareholder dividend, they can diversify that net worth and continue running their business day to day.
Okay, again, it goes back to I'm not handcuffing the business by taking money out of it, but also at the same time, if I don't, I'm kind of handcuffing myself because everything's in the business. So if I wanted to invest in something else or do something personal, this is an option for that.
Exactly. Yes.
Okay. What
Yeah.
would what kind of advice would you give to the family-owned businesses that are planning for the next generation? Like what are some basic things they should start considering?
Great question. I would say understand your options. I think it's not as well known that a fund like us exists where we can come in and help provide liquidity while getting the next generation into the ownership seat. So, understanding your options, having different conversations with different capital providers, and then just understanding what once those conversations progress, understanding who you're partnering with because it is a partnership and taking references on any capital provider that you're going to bring in and understanding how that capital provider behaves when things are going well, but also when things are going poorly, because that's when I think true actions start to show. And so taking references on good investments and prior investments that might have had some bumps in the road, and starting those conversations early to understand the options that exist and then what makes the most sense for your company, yourself, and the next generation.
Okay. We talk to a lot of business owners, all different shapes, sizes, mindsets, family, legacy goals. In the case of, I have a next generation but isn't interested in business, where does that sit in this spectrum? They're
Yeah, yeah, great
to
question.
to to get out. I don't have anybody in my lineage that's going to sit on the throne, for lack of a better term.
Right.
Um, I might have some people in the business that could take over, yet to be determined if they're really serious about continuing on carrying the torch. And so, is Caltius still an option for that business owner who's kind of like, I want to get out, I want to exit, or is it more I should just look to go to an M&A or a business broker to find somebody who wants to buy me outright?
I think the latter. We're not likely the right solution in that situation if there's not a next generation that's looking to go into the majority seat.
Okay.
Then a private equity fund or a strategic who's just going to buy the business is likely a better option.
Okay. So in that regard, then you spend a lot of time looking at management teams. You spend a
Mhm.
lot of time looking and analyzing. If you get 500 people coming in, you only take four. You got to look at a lot of people out there. And so, what are the qualities of the founder and maybe the next, you know, next generation, whatever that may be, internal to the business family? What are the qualities that really stand out to you?
Yeah, great question. I would say one, just honesty. No business is perfect, and we spend a lot of time doing diligence on a business. And if we find something that was not told to us, it is a much bigger issue than if the management team says outright, hey, we have a good business, but this is happening, or you should be aware of this. Then we trust that management team, and that speaks volumes. We don't want to partner with people, and we can't partner with people that we don't trust because they're running the day to day of the business. So we have to feel good about who they are, and the way that they run their business. I would also say building a team around the business owner, because it just we're humans. We can't be good at everything we do, and so bringing in good people to help you run your business is always wonderful. So when we see a business owner who is a great entrepreneur, but that person has surrounded him or herself with, a great CFO and a hungry salesperson, and has really expanded the duties of the team and trusts their lieutenants to go out and run their respective fields, that's always a big green flag for us.
Awesome. So number one, you need to know what's going on. You need to know what you're stepping into or potentially stepping into to make a good decision. Okay. I agree with that. I think there's got to be an honest representation so that you have the ability to make a wise choice, and it's not the narrative is being controlled. Um, and then number two, the business can't be so dependent on the owner that it can't stand on its own legs without the king being in the throne or the queen.
Right. And the owner is willing to spread the responsibility around. We like seeing that as well. We often see businesses that are very reliant on the owner, and that's fine. That person started the business and probably holds a lot of the relationships, but we love to see that they've spread the responsibility around to others as well.
For the business owner founder that is starting to consider raising capital, obviously you guys have been in this from the kind of the opposite side or opposite side of the lens. Um, what advice can you give to um, a founder, business owner that might make some of those common mistakes in the first time that they're raising capital?
Great question. I think going back to what we were saying earlier, bringing in someone like you all, like Enterprise Sage, that can help them sophisticate the financials, understand, maybe various tax implications or various implications of running a business, and going through a capital raise can be very helpful. And I would also say, the earlier that you can get your financials and financial systems in a good spot, the better. And we don't need, sophisticated CFO who has 30 years of experience. That's not what we're looking for. We oftentimes see financials that are on QuickBooks and compiled audits and sometimes even cash financials. That's all fine. We can work through all that, but we
Okay.
need to see monthly financials. We need to at least be able to look at the performance of the business. And then I would also say having KPIs and tracking around revenue to customers, revenue to various end markets, what's recurring versus non-recurring, just those various KPIs and metrics in place is also helpful.
Okay. Okay. Good to know. Um, I don't want to paint a rosy picture, rose-colored glasses, but I do, and I also don't want to put a dark cloud over it. But what are some things that maybe business owners, founders don't worry enough about?
You are partnering with this institutional capital for the next 5, 6, 7 years, and you should know who you're partnering with. And so I cannot stress enough that before business owners partner with institutional capital, whether it's a senior bank, whether it's folks like us, or whether it's a buyout private equity fund, take references. And we recommend and encourage that if we're looking at creating a partnership, the business owner can go to our website and just pick any company they want. They can just pick random people and we will introduce them to whoever they would like to speak to. But we really try to ensure that they speak to executives where things had gone correctly and to plan, and then executives where things had not gone correctly and had not gone to plan, because that's where you see the true colors of the institutional capital that you're partnering with. And I think that's when you find out how people act in situations that were not planned for. And that can be very telling. So take references, hear about the good, but also make sure you hear about the bad.
Okay. Yeah, because you're driving the car off the lot. How's it gonna feel once you put another 20, 30,000 miles on it?
Exactly, exactly. And things happen, budgets are missed and there are down years and macro environments change, especially these last few years. We've had a lot of transitions and a lot of impacts from the macro environment to businesses. And so you need to know how the person that you're partnering with is going to react in those situations.
Absolutely. Okay. I like that. I think that's good advice for anybody in any environment. Cap raise business, it's important to understand who you're working with and how do they work and what's that going to look like down the road. So
Absolutely.
you've been in this world for a number of years. Caltius has been doing this for almost 30 years. How has the lending component and M&A environment changed over the last few years?
Yeah, great question. I think, during COVID, we saw a very frothy M&A market. There were a lot of high valuations and a lot of private equity activity. And with that, private equity, not all, but in some cases, put a lot of leverage on businesses, meaning they put more debt on businesses than we would have seen in other years. And so I think, the pendulum swung and now it's swung back to a more normalized state. And we at Caltius have always maintained that we will continue to put a conservative amount of lending and debt on businesses. So I think, over the last 30 years have stayed pretty true to ourselves that we put a conservative amount of leverage on businesses. We don't overlever, even if the M&A community is frothy and putting a lot of leverage on the businesses. So as that pendulum has swung back, senior banks have stopped lending as much capital as they were maybe 2, 3, 4 years ago,
Mm.
which provides a gap for then that's where we can come in and provide more capital than they might be comfortable providing. And then I would also say, as valuations have cooled a little bit, it's also makes our alternative to a sale a little bit more attractive because maybe a business could have sold for 10 times when everything was very frothy in 2021, but now that business would only sell for 7 times. We
Hmm.
can come in, provide that shareholder dividend, allow that business owner to take some capital now, but continue holding on to the business and grow it, and potentially wait for valuations to increase.
Interesting. So kind of some parallel between like the housing market of the early 2000s, where banks were lending, giving people a little too much. Businesses were valued a little too high, so there was a little bit of embellishment there. So interesting. That's a neat thing to start to tie together. And so now what we're seeing is businesses are being true to size, true to fit for their valuations. There's not as much debt on them. Okay, very cool. AI is the buzz nowadays. I mean, it's been growing rapidly, and if you haven't heard of AI, you've been living under a rock, which some days sounds like a pretty good thing.
Yeah.
But all to be said, it's here, it's now, it's only going to be here, it's only going to keep growing. How do you feel that AI and technology is changing the way investors evaluate businesses?
Great question. I think it's still early.
Okay.
And it's hard to project how even it will look a year from now, but I can speak to how it's changing my day to day and how it's changing how I'm viewing opportunities now. In terms of day to day, I think it's taking out some of the grunt work of working at a fund or an institutional investor, meaning that it can now quickly analyze data rooms, it can quickly put materials together, it can do some of those. Administrative, if you will, diligence items. What AI cannot do is it cannot sit across from a management team. It does not have the emotional intelligence to understand if what a management team believes about their business makes sense and if they can likely execute it. And it cannot do any of the human interactions that are so important in making an investment decision. So I think it does, free up some time by doing some of the administration work, but it cannot make investment decisions, and it will never be able to make investment decisions because it can't have those human interactions. So that's how it's changing my day to day. In
Yeah.
terms of evaluating investment opportunities, the way that we're looking at it right now is understanding one, if it could highly disrupt the industry in which the investment opportunity is in, and then also how it can make it more efficient. And we're seeing more deals in which it can make the business more efficient than it can completely disrupt the business. So I think, as my example, it can make it more efficient, but it's not going to disrupt it. And we're seeing that across most businesses that we're currently evaluating.
Yeah, so give a good starting place, maybe take out some of the grunt work, but it's never gonna truly understand what's the company culture, what are the people like that work within the company. That is something that is still a human element to the due diligence of acquisitions. Um,
Absolutely.
okay, yeah, I can see that. Um, we work a lot in middle markets. You work a lot in the middle market. So the middle market business owner, what should they really be paying attention to in the in that market space over the next 5 years? Like, what trends do you feel like are happening that really should the business owner who's in that, I'd say that 1 to 50 million range, really be like keep an ear to the to the road?
Yeah, great question. I think a lot of business owners are getting close to retirement age. And so these types of conversations are very beneficial to them to understand the options of liquidity and the options of growing your business before retirement. So we're seeing that a lot in the lower middle market and middle market. And then I would say, in terms of everything industry specific, business owners know that better than we do, and that's why we're not coming in and running businesses. Is we know that they know the industry and their businesses better and have a better idea of what they need to keep a ear out for. So I would just say where we're more experts is on the finance side and the capital raise side and the alternatives to a sale side. And in terms of that, just know that other options besides selling majority to private equity exist.
Okay. Okay. So for those business owners, if they think that they're going to be needing capital in the next couple years, what is something they need to start doing today?
I having financials that are easy to read and are tracked,
Okay.
tracking KPIs, understanding and educating themselves on the different types of capital and the different types of the raising capital that they could do and transactions that could make sense for them.
So some things that may not be the most fun or get the business owner up in the morning, but we got to have good, clean data. Anybody should be able to see at any point in time, like where do we stand financially, what's coming in, what's going out, all that kind of good stuff. Okay. And then what was the one other thing you mentioned to the business owner that really should be easily accessible or something I should really have nailed down?
That alternatives to a sale exist, and there are ways to raise capital without ceding control. If there was one point that I hope business owners could take home today, it's that you can raise capital and you can solve ownership transition problems, or you can take out shareholder liquidity, or you can raise acquisition financing without having to seek control.
Okay. Okay. So we know we need data. So give me just like the handful of financial records or reporting systems that make your due diligence process easier.
Absolutely. I would say, I mean, the top one is just good financials. So data, financials, tracking KPIs, understanding, if you go through the P&L,
Yep.
understanding what's driving the revenue and then understanding what's driving the costs are really the easiest way to think about it. So on the revenue side, how are the contracts structured? Who are the
Yep.
customers? What are the terms around how you are driving the revenue coming in, and what have the trends been historically, and what do you think the trends will be going forward and why? And having good handles on all of that information makes the diligence a lot easier. And then same thing on the cost side. If it's a people business, understanding wages, understanding hours, understanding churn, understanding employee KPIs is very important. If it's not a people business, and it's a material business, understanding, the costs that go into those and supplier relationships and what's driving price increases or price decreases within the cost side. And then looking at G&A and understanding your bonus structure and understanding your rent and everything that goes into the P&L, but then taking it back a few layers and what's actually driving it and causing any variability is where we spend a lot of our time. And if entrepreneurs have a good handle on all of that, it makes our job a lot easier.
Okay. So for those of you listening in, what Kate's saying is that every founder, probably this next quarter, probably should really sit down with their financials and those people that are doing the financials on a regular basis and make that much cleaner, maybe more easy to read, and have a greater understanding. I wouldn't just say numbers in, numbers out, but also understand the predictability of things in the next 3, 6, 9, 12 months. So it's doing some projection out there, not going, well, we did this, and if we, this should happen again. Okay, but have a better understanding of what can, could, and should happen. What's another thing that you think is valuable to business owners that they could start to address or become aware of in this next quarter?
I would say expanding network to people in the M&A world if you are interested in ultimately an exit through the M&A world, whether that's a full sale or whether that's a capital raise and a solution like Caltius.
Got it.
Just having advisors you trust, having relationships that you trust. So then when it becomes time for you to actually start the process, if you have a question, you know who to call, and you can have a trusted third party that's either an advisor to the company or maybe just a friend, who understands the M&A world, because these entrepreneurs, these are their babies, and to have finance is a whole new language, and to have someone that you can trust that can help you through the process is invaluable.
So we shouldn't wait till the fourth quarter, the 11th hour
No,
to
I don't think so. I don't think so. Yeah.
start
I
networking
would
with.
say just go make some friends. Go out in the market and make some friends and
There
make
you go.
some introductions and reach out to Darin, reach out to me if you want to expand your network in the M&A world, but also look up who is in your area and just try to find some trusted advisors.
And if you're in the Denver area, next spring you can come to Sips and Swings. There's a
Yes.
shameless plug for you, Kate. Great
Thank
little
you.
event. But also ACG Denver. There's the M&A and A chapter of Denver, Rocky Mountain chapter. Would be great ways to, as a business owner, get connected with professionals in that arena that not just exits, but also lending and also other types of capital solutions that are out there too. So
Absolutely.
um, we've been going strong, Kate. I love it. We've got a few more questions for you today to kind of tie this thing all up in a nice, pretty package.
Sounds good.
What is the one thing that business owners should do before partnering with a capital provider? Obviously, you do your due diligence, but if I'm a business owner, like what's some good sage advice that you could give to a business owner that's looking for capital?
I have said it before, but I'm beating a dead horse, but it is really important. Take references. Understand who you're partnering with because you are signing legal documents with these people and that you're bringing them into your business and you need to understand how they behave and the best way to understand that is by talking to people that they've partnered with in the past and can give you real life examples of how they interact day to day when things are good and when things are bad.
That is again, we're hitting this again, but it's good to revisit things over and over so we get it in our brain. So the takeaway from today, guys, if you're listening and gals, is really do some due diligence. Don't fall in love with the option. Stay objective. Find out who the people you're going to be working with, not just for the here and now, but what's that going to look like a few years down the road too. Kate, this has been wonderful. I want to give our listeners the opportunity to get in contact with you and Caltius. So, where can people go to learn more about all the wonderful things that you guys do to determine if it's a right fit for their business or not?
Yeah, absolutely. I love talking to people. So if you're interested in learning more, you're more than welcome. Reach out to me on LinkedIn, Kate McDonald. Find me on LinkedIn, shoot me an email. Find us on the Caltius website, caltiusstructuredcapital.com. And if you're in Denver, would love to grab coffee, meet face to face. So absolutely, please reach out if I can be of any help with any type of capital solution. I'd love to chat about it.
Kate, thank you so much for your time today. And it's wonderful as always to get to speak with you. I always feel like I'm learning something new. Hopefully, the listeners as well learned something, broaden their scope and horizon on where they can go for capital solutions. But been a great conversation today, Kate. Thank you again for joining us on
Thank
the
you.
Build Business Better podcast. And for those of you who are listening in, we'll have another great episode coming up on the show very soon. Hopefully, Craig is safe on his motorcycle today. And guys, work on your business. If you need help, you got a lot of great people to talk to. So we'll talk to you soon.
Thank you, Darin.
Yep. Have a great day. Bye.